All right, so today we're diving deep into entrepreneurial finance
Yeah.
using Greg Crabtree's book, Simple Numbers, Straight Talk, Big Profits. It's like if you're a new business owner,
Hmm.
it's like the cheat sheet, right?
Yeah.
To building a profitable business
That is.
from the ground up.
Straight talk. No BS.
Yeah, and finance can be kind of scary,
Yeah.
but Crabtree really breaks it down in a way
He does
that
it.
makes it easy to understand.
He makes it very simple.
He's worked with hundreds of companies, so he's seen it all, right?
Absolutely.
So this is like our shortcut
Yeah.
to avoiding some of the biggest financial mistakes that entrepreneurs make.
That's right. And the nice thing about Crabtree is he's not afraid to tell you what you need to hear, not necessarily what you want to hear.
Right. It's like tough love.
A little bit of tough love,
Yeah.
but it's all based on real world experience.
Exactly.
And, really actionable advice.
So one of the first things he talks about are these 4 keys, right, to building a profitable business.
Foundational.
And the first one, I was really surprised by this, that you should be paying yourself a market-based wage.
From day one.
From day one.
Yeah.
Now, why? Isn't the whole point of starting a business so you can make a ton of money?
Right. That's a common misconception, and I think it's a dangerous one.
Yeah.
What he's saying is that if you're not taking a salary for yourself as part of your business expenses,
Right.
you're not getting a real picture of what your profit actually is.
Okay.
It's like, saying you're going to bake a cake,
Yeah.
but not using flour.
Right.
You might think you're doing pretty well, but it's not going to turn out the way it should.
He even tells this story about a client
Oh, yeah. Great story.
who thought they were making like a 20% profit margin.
Yeah. Killing it.
But they were only paying themselves a tiny salary and taking distributions to make ends meet.
Exactly. Yeah.
But when he actually factored in what they should have been paying themselves,
Their true profit was
their profit was only 5%.
5%.
I mean, that's a huge difference.
Huge wake-up call for that guy.
Absolutely. And this really highlights why understanding pre-tax profit is so important, right?
Absolutely.
Yeah.
That's it's the true measure
Yeah.
of your business's health.
Okay.
It tells you how much money you're actually making before you pay Uncle Sam.
Okay.
And speaking of things that can distort your profit picture, Crabtree's got a real bone to pick with EBITDA.
Yeah. That's that acronym gets thrown around a lot, especially in the startup world.
It does.
But he says it can be really misleading for smaller businesses.
Yeah, it can.
So just to remind everyone, EBITDA stands for...
Earnings before interest, taxes, depreciation, and amortization.
Okay, now, for larger companies, it can be useful.
It can be useful.
But Crabtree argues that for smaller businesses, those components, the ITDA,
Right.
they're real costs that need to be factored in.
They are.
So you can't just ignore them, right?
You can't ignore them. It's like pretending you don't have to pay rent
Right.
or replace your equipment.
So key number 2 is all about gross profit.
Love gross profit.
And he describes it as kind of like this universal language for comparing businesses across different industries.
Mm-hmm. It's your revenue
Okay.
minus your direct costs, right?
Yeah.
Or as they say, cost of goods sold.
Yeah. So if you sell a product for $100
Yeah.
and it costs you $60 to make and deliver it,
Mm-hmm.
your gross profit would be $40.
$40, yeah.
Okay.
And that really helps you understand how efficiently you're turning that inventory or service into revenue.
Which brings us to key number 3, the break-even point,
Love this concept.
which is the point where your revenue is just enough to cover all your costs,
Both.
right? Fixed and variable.
Yeah,
And he even has a little profitability scale to kind of help you figure out
he does.
where you stand.
Yeah.
So he says if you're at 5% or less pre-tax profit,
Life support.
you're on life support, you're barely scraping by.
Barely scraping by.
10% pre-tax profit, you're doing okay.
You're doing okay.
But there's room for improvement.
Always room for improvement.
And then 15% or more.
Yeah.
You're in great shape.
You're rocking it.
You're rocking it.
Built a good, solid foundation.
Okay, so now we get to key number 4, which is profit distributions,
Yeah.
which is like all the rewards, right,
Yeah.
for your hard work.
Right. You think so, right? You think
Yeah.
you get there.
Yeah.
You're just going to rake it all in.
Right.
But not so fast, says Crabtree.
Not so fast.
Distribution should come last.
Okay.
In the order of cash flow forces.
Okay.
So, before you even think about taking money out of the business, you got to make sure you've covered your taxes,
Okay.
paid back any debt,
Mm-hmm.
and reached that core capital target
Right.
that we were talking about.
So it's like you're prioritizing the uses of cash,
Absolutely.
not just like taking it all out at once.
That's right. It's he calls that cash cow disease.
Oh, I like that.
Where you're killing the cow for one big feast instead of, nurturing it for the long-term milk production.
So you want that nice steady stream.
You want the milk. You want the milk.
Of cash flow, yeah.
That's right. That's right. Building a successful business is a marathon, not a sprint, right?
Oh, okay.
It's about making consistent, responsible financial decisions that support sustainable growth.
To illustrate this idea, Crabtree compares two companies.
Yeah.
Company A and Company B.
Love these examples.
And both companies have similar revenue growth.
Right.
But Company A is just focusing on increasing revenue.
Revenue.
But they're not really paying attention to profit.
Right.
While Company B is prioritizing profitability from the get-go.
Yeah, they're focused on the bottom line.
Okay, so what happens?
Well, what's fascinating is even though both companies had similar revenue, their outcomes were dramatically different.
Okay, so Company A.
Struggling to stay afloat.
Okay.
Almost no equity growth to speak of.
Right. But Company B.
Yeah.
They're building this big equity base.
They are, over time.
Right. And they can even start taking distributions.
Exactly.
So that's a pretty powerful illustration, right?
Absolutely.
Of why profit really matters.
And it's not just about the top line, right? It's about what you keep after you pay all your costs.
Right.
And, invest back in the business.
So let's talk about this idea of a salary cap for your business.
Okay.
I love this concept. And it's this way to, strategically manage your labor costs so that you can hit your profit targets.
It's a great analogy. He uses the football team analogy, right?
Oh, yeah.
You can't just throw all your money at the star quarterback
Right.
and expect to win, the Super Bowl.
Right.
You need a balanced team
Okay.
with, talent in all positions
Right.
to really succeed.
Okay.
And it's the same principle.
With your business.
With your business, you need to allocate your labor costs strategically across all areas, to create a well-rounded, efficient operation.
So he actually provides a step-by-step guide.
He does.
For how to calculate your salary cap, right? And it's based on that target of 10%.
Pre-tax profit.
Pre-tax profit.
That's right.
So first, you figure out your non-salary costs, like rent, utilities, marketing, all of that stuff. And then you subtract that from your total revenue, and what's left?
Is your salary cap.
Is your salary cap.
The total amount you can allocate to labor.
And still hit that 10%.
10% target.
Okay.
Pretty simple.
Right. It's a pretty simple calculation.
Lets you break it down.
Yeah.
Yeah.
But here's where things get interesting.
Okay.
Crabtree says raising your salary cap is directly tied to hitting higher profit targets.
That's right. So if you want to go from, 10% to 15%.
You need to increase profitability first.
Profitability first.
Before you can even think about raising that cap.
Exactly. It's like this beautiful feedback loop, right?
Yeah.
Increased profitability creates room for a higher salary cap, which then allows you to attract and retain top talent,
right?
Which then drives even greater
profitability. So it's like a virtuous cycle.
Virtuous cycle, for sure.
But he also warns, if you try to raise the salary cap
too soon,
when your profitability is low, that's
recipe for disaster.
A recipe for disaster.
It's like adding more weight to a sinking ship, right?
Right. Now, even if you're hitting those profit targets,
okay.
Crabtree says that there can still be this gap between your profit
and your cash flow.
Especially in the early stages.
Especially early on.
Of a business.
Yeah.
So he gives this scenario. You make $125,000 in pre-tax profit, but you only have $25,000 in cash at the end of the year. What happened?
Yeah, where'd the money go? Right. This is very common for entrepreneurs. But it really highlights the importance of understanding the timing of when cash comes in and when cash goes out.
Right. So you might be profitable on paper.
You might.
But if your customers haven't paid you yet.
Or you've had to make, a big upfront investment.
Then you can be short on cash.
You could be short on cash.
And that's where the 4 forces of cash flow come in.
Love this concept.
And Crabtree says these are like the 4 fundamental forces
of nature
that govern your cash flow.
They do. And
understanding them is super important.
Crucial.
To avoid financial meltdowns.
Absolutely. It's about taking a holistic view of your finances.
Right.
And recognizing that profit is only one piece of the puzzle.
Right, and you need to manage
all four forces.
All four forces.
To make sure you have the cash you need when you need it.
So what are these mysterious forces?
Yeah, what are they?
That hold the key to cash flow mastery?
Let's find out.
Let's find out. All right, stay tuned for part 2 of our deep dive, where we'll unlock the secrets of the 4 forces of cash flow.
So the first force, and maybe not the most exciting one, is paying taxes.
Okay.
You know, a lot of people think of taxes as something you just deal with once a year.
Right.
But Crabtree says, you know, you really need to be thinking about your taxes all year round.
Okay.
And he actually recommends setting aside money specifically for taxes.
Okay, so like as you're making money.
Put
some aside.
Put it aside.
For tax.
That's right. Think of it like paying Uncle Sam before you even touch the money.
Right.
He suggests using this safe harbor method where you're either paying, you know, what you paid in taxes last year or 110% of last year's taxes if your income is above a certain threshold.
Okay.
That way you avoid those underpayment penalties.
Okay.
And you're not scrambling at the last minute.
Makes sense.
Yeah.
So when it comes to accounting methods, he's a big fan of cash basis accounting for smaller businesses.
Keeps things simple.
Yeah.
You know, you're recording income when you receive it.
Okay.
Expenses when you pay them.
So it's like
straightforward.
Yeah, like balancing your checkbook.
Right.
Very straightforward.
All right. So force number 2 is all about debt. Debt. And Crabtree is pretty clear. You can't really build wealth until you're out of debt.
That's right.
He compares debt to like an anchor.
Yeah, dragging you down.
Holding
you back.
Limiting your flexibility.
Absolutely.
And, you know, just really making it hard to grow.
It eats into your profits.
And he makes this distinction between lines of credit and term debt.
Right.
Lines of credit, he's like super cautious about those.
He is. You know, they offer this easy access to cash.
Right.
But can tempt you to overspend.
Right.
He compares them to crack cocaine.
Oh, wow.
Addictive, right?
Yeah. You know, you start relying on that quick hit of cash to cover expenses.
Right.
Or maybe make some impulse purchases.
Yeah.
And next thing you know,
you're in trouble.
You're drowning in debt.
So term debt is more like...
more structured.
Okay.
You've got a fixed repayment schedule.
Okay, so you know what to expect.
Clear path to becoming debt-free.
So it's more like kind of like your mortgage.
Like a mortgage or a car loan requires more discipline.
Yeah.
But it's a healthier approach long term.
He tells this story about a client.
Oh, yeah.
Who took on all this debt to buy equipment, thinking they were like being smart.
Taking advantage of tax benefits, you know? But that debt ended up really hindering their growth. Put a huge strain on their cash flow.
So it's like short-term gain.
Yeah, short-term gain.
Long-term pain.
Long-term pain.
Okay, so force number 3 is reaching that core capital target.
Love core capital.
What we talked about earlier.
Yes.
And he says, you know, this is a top priority after paying taxes.
Yep.
And paying off any debt.
That's right.
And just to remind everyone, core capital is
2 months.
Financial
2 months of operating expenses in cash.
In cash.
That's right. It gives you peace of mind.
Okay.
Knowing you can handle unexpected challenges without panicking.
And he really emphasizes
he does.
Like building that core capital takes discipline.
Discipline and delayed gratification.
Yeah, you're not, you know, spending it all right away.
That's right.
You're saving it.
Saving it for a rainy day.
Okay.
Building that foundation.
So he makes this distinction between debt and capital.
Right.
Debt is, you know, money you borrow.
Borrowed money.
You got to pay back.
With interest.
With interest.
Yeah.
But capital is what you've built up.
What you've earned.
Within the business.
Yeah, you've built it up.
And he even debunks this myth.
Oh, yeah, common myth.
That you can just withdraw.
Oh, I'm just going to take it all out.
Invested capital.
Yeah, once the business is stable.
It's like, nope.
Nope. That's not how it works.
That stays in the business.
That stays in the business.
It's like the foundation.
To the foundation.
Of the business.
Absolutely.
Okay. And then finally we get to force number 4.
Here we go.
The one we've all been waiting for. Profit distributions.
Yeah. The fun one, right?
Yeah. The rewards for your hard work.
Finally.
But remember,
Finally.
This comes last.
Last.
In the order of cash flow forces.
It's the dessert.
Okay.
After you've eaten your vegetables.
I like that.
You know?
Okay.
You got to take care of the essentials first.
Yeah.
Then you can have your treat.
Okay, so he says you need to take distributions formally.
Formally and responsibly.
Responsibly, okay.
Treat it as a separate line item in your budget.
Okay.
And keep those personal and business finances separate.
Okay.
You don't want them getting all mixed up.
Right.
That can get messy.
So distributions should really reflect,
the health of your business.
the health and sustainability.
Absolutely. He warns against, falling into that cash cow disease trap.
Right.
Killing the cow for one big feast instead of nurturing it for the long term.
Gotcha.
It's all about patience.
Right, yeah.
Long-term perspective.
Okay, so we've explored these 4 forces of cash flow.
We have.
That govern your cash flow.
That's right.
Now, let's shift gears and talk about maximizing labor productivity.
Okay.
This is where we go from, the financial mechanics to really thinking about
your people
as your most valuable asset.
Most valuable asset.
And he calls this the salary economy.
I like that term.
Yeah, it's like recognizing that managing labor costs isn't just about setting wages.
Right. It's much more than that.
It's about understanding the value each employee brings.
Their contribution.
Right.
Yeah.
Aligning their skills with the needs of the business.
Absolutely. And creating a
productivity.
A productivity.
That fuels profitability.
Okay. And he says, this isn't about squeezing every penny out of your employees.
Not at all.
It's about creating that win-win.
Win-win.
Right.
Where everyone benefits.
Where employees are compensated fairly.
Fairly.
And the business benefits from their skills and dedication.
Exactly.
Okay. And he talks about gross profit per labor dollar.
Yeah. Great metric.
As a key metric.
It tells
you evaluate,
how much profit
your workforce.
Each dollar you spend on labor is generating.
Okay.
Really important.
So it's a good way to see,
yeah, are you getting a return?
Are you getting a return?
On your investment.
On your investment in your people.
Exactly.
Okay, so we've talked about capital, right?
Yeah.
And how important it is to know what your business is worth.
Yep.
But let's get practical. How do you actually track how your business is doing financially?
Yeah, good question. Crabtree's a big believer in checking your numbers regularly, not just at tax time, right?
Not just once a year.
He calls it establishing clear reporting rhythms.
Love that.
And it's all about having a system that gives you the information you need.
Yeah. At the right time.
At the right time, right. So you can be proactive.
Be proactive.
About managing your business. Imagine trying to drive a car without a speedometer.
Or a gas gauge.
Yeah. That's kind of what it's like trying to run a business without a clear understanding of your financials.
Absolutely.
So he suggests different reports for different time frames. So for a quick daily check, just keep an eye on your cash balance.
Yeah. How much money do you actually have in the bank right now?
Exactly.
That's really important early on, right?
Yeah, when cash flow could be
tight, unpredictable.
Yeah. It's like checking your bank account every morning.
Exactly.
To make sure you can
cover those bills.
Cover your bills, and you're not going to get hit with any overdraft fees.
No surprises.
Right. Okay, then for a weekly review, he suggests a cash flow forecast.
Okay, yeah.
And that's basically like a projection of your cash coming in and going out over the next
few months.
Yeah, few weeks, few months.
That's right.
And that can help you
anticipate any shortfalls.
Right, and manage your liquidity.
It's like a weather forecast.
Oh, I like that.
For your cash flow, right?
Yeah.
You can prepare for those storms.
And make sure you have enough cash on hand.
That's right.
To weather the storm.
Absolutely.
He also recommends a weekly sales and productivity report so you can
see how are you tracking?
How you're tracking
toward those goals.
Towards your revenue and profit goals, right?
Right.
So you can see if you're,
ahead, behind it.
Make
adjustments, yeah.
It's a good weekly progress report.
Yeah.
Celebrate those wins. Identify areas for improvement.
Okay, and then for a monthly review, he recommends really digging into your profit and loss statement.
Yeah, the P&L, your balance sheet. And where the cash goes.
Yeah.
Report.
Yeah, that's a good one.
So you can see.
Where did it all go?
Yeah, how that cash was used during the month. And these monthly reports give you
a really good picture.
Yeah, more detailed picture of how you're doing financially.
The overall health of the business. Those trends in revenue and expenses.
Okay.
Assets and liabilities, cash flow patterns.
And he really stresses keeping these reports
simple, clear, concise. Yeah.
Focus on the key metrics that drive your business.
Okay. And use visuals.
Visuals are great.
Like charts and graphs. To make the data
easy to understand.
Easy to understand, yeah.
Make the data come alive.
Don't just get lost in
a sea of numbers.
Yeah.
You focus on the things that are actually going to make a difference.
And remember, he says, connect that P&L to your balance sheet.
Absolutely.
So you can see how they relate.
The relationship between profitability and cash flow, yeah, you could be profitable on paper, but if you're not managing your cash well...
Right. I could still run into problems.
And that's where, understanding that connection
is crucial.
Is really important.
Yeah, it's like, you have a leaky bucket, right?
Right.
You might be pouring water in the top.
Yeah.
But it's leaking out the bottom faster than you can fill it.
Right.
You're never going to have a full bucket.
Makes sense.
You got to fix those leaks.
Okay, and then finally, use rolling 12-month data.
Yeah, that's a good tip.
To analyze those trends and smooth out any seasonal fluctuations.
So you get a better picture
of your long-term performance.
Of the long term.
Right.
It's like looking at your business through a wide-angle lens.
Okay.
Instead of a zoom lens.
Yeah.
You get that broader perspective.
Okay, so we've covered a lot today.
We have.
We talked about the 4 keys.
Yep, those foundational keys.
Cash flow.
Forces of cash flow.
Labor productivity.
Maximizing productivity.
Value in your business.
Yes. Knowing your worth.
And even, the philosophy of profitability.
The deeper meaning.
Right. It's been a lot.
A whirlwind tour of entrepreneurial finance.
Yeah, but we've really just scratched the surface.
Yeah, there's so much more in the book.
Of what Crabtree has to offer.
He really goes deep.
So hopefully you have a good foundation now, right?
Solid foundation.
A taste of the kind of wisdom and insight that he has to share.
And the possibilities.
Yeah, and the possibility.
When you start thinking about your business.
Through that financial lens.
That's right.
And remember, his book is a great resource.
Keep it handy.
Yeah, keep it handy.
And his website has even more tools and guidance.
Exactly. So before we wrap up, here's a question for you.
Okay.
Knowing everything we talked about today, about building a financially sound business, what's one bold action step you can take this week?
Yeah, to move your business forward.
And it doesn't have to be huge, right?
No, it could be small.
Just something to get you going.
It could be reviewing your pricing.
Sending out invoices.
Talking to your team about productivity.
Right, just something.
Take action.
Take action, yeah.
Put these principles to work.
Well, thanks for joining us for this deep dive into entrepreneurial finance.
It's been a pleasure.
We'll see you next time.
See you next time.
For another insightful exploration
of the ideas that shape our world.